let's ask Tom Lee. He is Fund Strats Head of Research, a CNBC contributor, and he is live as you see. Welcome back.
Great to see you, Scott.
Man, you nailed this thing. You really did. You had a sense that this market was coiled for a really big spring back, which we've had. So what do we do now?
Well, one, I think that the market's rising for the right reason, Scott, because it's rising because the tail risks are abating and we've had good fundamentals. In fact, earnings have been good enough that estimates are going up. And the leadership is coming from the groups that we want to see, which has been the Mag 7 and the tech and the cyclicals. And that's what you want to see if the market is showing sort of economic resilience. So I'd say for now, our base case is tracking. We still think we're going to make a good move towards 7,300 for the S&P 500. And today we did raise software, which is also the ETF IGV, to beat a top pick sector alongside Mag 7 and crypto.
So let me ask you this. I hear you. Market's obviously rising for the quote-unquote right reason. I mean, earnings growth in April, this is amazing, was projected to be 14.1%. Tom, we're clocking 28% earnings growth.
Yeah.
That's remarkable. That's why the market's been looking outside of the oil complex and away from the war and any of the other, rising rates from time to time. The market is just not having it because it's busy feasting on these earnings.
That's right, Scott. In some ways, it's showing you that revenue growth, which has been better, is delivering each dollar of upside to revenue is delivering a lot of earnings growth. So there is a margin story at work, which people would say is productivity, but it shows you the return on investment for the U.S. economy is also going up, meaning I do think that this is an example of AI actually having positive payoffs for the economy and for earnings.
Yeah, what about tech, Tom, and areas of the market that, to some at least, are starting to look overbought? And I'll get into that a little bit later in our A block here. But for example, 1 month, okay? In 1 month, the Nasdaq's up 15%. You've had a bit of narrower breadth in the market, to which Goldman's Ben Snyder today says sharply narrowing breadth has historically indicated equity market drawdown risk. S&P's up 14% from the low in March. The median S&P constituent, however, remains 13% below its respective high. How do you reconcile that?
I think that I'm going to look at this as a series of rolling bear markets because we know the Mag 7 and the software stocks peaked a lot earlier than the broader market did. And then they led into the low, but then bottomed first and are rallying. So I think that we should expect breadth to follow, but it would be pretty textbook because, tech is what peaked earlier, several months earlier before the index level market actually peaked.
I mean, we're almost at 7,300 as I ask you these questions. 72.38 is where I'm looking at right now on the S&P. Where are we going, Tom? You figured we'd get here because you said as much when you thought we hit the bottom. But, we've come so far so fast. Does that mean we've stolen some from the future and moved it forward? What does that tell us?
Well, I know strong markets tend to, and I'm going to sound not very original, but strong markets stay strong. So I think the strength that we've seen is a good sign. And we also know when we look at the data that institutional investors caught the bottom. But I think in 2026, it's retail that kind of missed the low, but they have a lot of firepower. So I think it's going to be a retail-driven buying of stocks. And that's why I think broadening can take place because, as you know, retail investors do like small and mid-cap stocks as well.